All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Today we're going to be talking about how long it takes to build up cash value in a life insurance policy. Many people have a misconception that it takes a long time to build up cash value, that you have to make premium payments every month, and life insurance is a high fee product and it takes a long time to build up cash value before you can actually leverage it. Well, keep in mind, this channel is devoted to the double play, which is putting your money to work in both real estate and life insurance. Not one or the other, but both. And people wouldn't be doing this if they had to tolerate taking their money and putting it into a high fee product where a lot of money turned into a little bit of cash value, and they may not even be able to access that cash value for some amount of time. If that were the way this worked, nobody would be doing it. So rest assured, if you're at this point and you haven't watched my earlier videos and you don't understand that 85% of your premium goes to the cash value, then stick around after the intro and I will break it all down for you. All right, thanks for sticking around. Again, today's topic is how long does it take to build up cash value in a permanent life insurance policy? And one of the goals of this channel is to debunk all of the myths and misconceptions about life insurance. And one of the misconceptions is that it takes a long time to build up cash value. It's not necessarily a myth, because certainly if you design the wrong type of policy, you will have a policy that will have very little cash value, and it will take a long time to build up. But in order to do the double play, we need to utilize a maximum overfunded policy. So what I want to do in this video is go over policy design, and I really want to explain life insurance as a spectrum between a maximum overfunded policy where you have low death benefit and high cash value, to the opposite end of the spectrum where you have high death benefit and low cash value. And once you understand that spectrum, then we can talk about how much cash value is available and how soon it's available to be leveraged. So let me take care of a few housekeeping items first, and then we'll get started. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so the first thing I want you to do is we need to bust the images that you have in your head that life insurance is this high fee product, that it takes forever to build up cash value, that you can pay months and months and months, and a policy could lapse if you skip a payment. That's just not the case in a maximum overfunded life insurance policy. And to help illustrate this, what I want you to do is just visualize a spectrum where at one end of that spectrum, you have a life insurance policy where you're getting the maximum amount of death benefit for the money. So picture calling up an agent and asking for a quote on $1 million policy. Well, in this case, the insurance company's objective is to give you that $1 million of death benefit protection at the lowest possible cost. So they're not going to collect any more than is absolutely necessary to perform on the obligations of that policy. So in that case, you're going to have a policy that is going to have very low cash value. They're going to try and keep the premiums to an absolute minimum. The fees and expenses of the policy will be subtracted from that, and the remainder is going to go to the cash value. And I should stop here and just point out, if you don't understand what the cash value in a life insurance policy represents, I highly recommend going and watching the Life Insurance 101 video. There should be a link to it on screen right now. That'll give you all the basics that you need to kind of keep up with me in this video. All right, so let's get back to our mental picture of a spectrum, where at one end of that spectrum is a minimally funded life insurance policy that has maximum death benefit and minimal cash value. And at the opposite end of that spectrum, it is the complete opposite. It's a policy that has the lowest possible death benefit and the maximum amount of cash value. So in this case, you're quite literally spending the most amount of money that you can on the least amount of death benefit. I know that seems kind of counterintuitive, but that's how you get cash value in a policy. And remember, the cash value is not an expense. It's not money that's going to the insurance company. The cash value is quite literally the policy owner saving up the death benefit for the insured over the insured's life expectancy. And if you were to surrender the policy, you'll get all of that cash value back. So the more cash value you have, the more is coming back to you if you were to ever surrender the policy. But in the case of the double play, that surrender value defines your credit limit on how much you can borrow against. So also understand that everywhere in between those two extremes is accessible. So a life insurance agent has tremendous flexibility to give you a life insurance product that meets your exact goals and needs. So if you want death benefit protection at the lowest possible price, well, then the agent is going to design a policy at the far end of the spectrum where you get the most death benefit for the lowest price. By the same token, if you are doing the double play and cash accumulation is your goal, then you're going to want a policy that is at the opposite end of the spectrum, where you're paying the most for the least amount of death benefit with the goal of having the most cash value. But at any point along that spectrum, we can trade cash value for death benefit or death benefit for cash value. So it's highly customizable and we can give you exactly what you want. A lot of companies like the Infinite Banking, Bank on Yourself, those folks typically design policies that sit somewhere in between. They're not maximum overfunded policies, but they're not minimally funded policies either. They're just simply overfunded policies. So the next question is, how much cash value is available? So if you look at the table that's on the screen right now, this is clipped out of an actual illustration, and this is a case where policy owner is trying to stuff premium into a policy in as short amount of time as possible to get to get their money into cash value that they could turn around and leverage. So there goes the myth that you are paying monthly for the rest of your life, and if you stop making premium payments, the policy is going to lapse. As you can see here, these are large annual premiums. They're only for 5 years. And if you look at the cells that I have highlighted in orange, we can see the $100,000 a year premium. And keep in mind, while I'm using $100,000, I'm doing that just for simplicity, just to keep the numbers nice and round and simple. And what I want you to understand is everything in life insurance is scalable. So you can add a zero, take a zero off, cut it in half, multiply it by 2, but the ratio of cash value to premium and the ratio of death benefit to premium is going to stay relatively constant. So getting back to our table, out of that $100,000 premium, you can see that we have accumulation value and surrender value of $92,777. You'll notice that that is far in excess of the 85% that I quoted earlier. But what I want you to keep in mind is that the end of year numbers that are on an illustration have the first year's dividend or growth factored into that already. To estimate how much cash value you would have on day one, you've got to back that growth out. So while we're here and looking at this illustration, one thing that I want to point out to you is that when we do a short pay, like 5 years, for example, take note of the death benefit at the far right column, and notice at the point where the premiums cease, you'll see that the death benefit also drops down substantially. And we do that to drive the cost out of the policy. So at that point in time, we've got the minimum legal amount of death benefit protection over the amount of cash value that's in the policy at that time. And what this does is it reduces and minimizes the load on the policy so that that policy is self-sustaining from this point forward. It doesn't require any additional premium payments. And mind you, this is true whether the policy is an indexed universal life or a whole life. I'm not getting into product specifics in this video. This is just life insurance in general. So next, I want to take a look at an illustration and show you the actual costs, for one, and two, show you what it looks like over a much longer period of time. Because not everybody has a large lump sum of money that they can dump into a life insurance policy over a 5-year funding period, for example. A lot of people are starting small and dropping as much premium into the policy as they can afford, and over time they're accumulating cash value. But just keep in mind, what cash value is in the policy is liquid and available from day one when it's properly designed. So here we have a policy for a 40-year-old that's putting $20,000 a year premium in every year for 26 years until they're age 65. If you turn your attention to the header and the cells that I have in orange, you'll see the header is labeled policy charges. And you'll notice that there is a premium charge, a cost of insurance charge, the policy issue charge, additional charges. And those charges are subtracted from the premium, and that results in how much cash value is there on day one of the policy. And then at the end of the year, the interest crediting or dividend crediting occurs. And that's when the growth is credited to the account. So when you're looking at that number, it's going to look, in this case here, if you do the math, divide 18,392 by $20,000, you're going to find that that's in excess of the 85% that I quoted. But again, if you back out that growth, you'll find that that number is usually 85%, give or take, if the policy is designed properly. Obviously, the more death benefit you put into the policy, the more the cost will be, and that will result in less cash value. All right, and finally, we want to talk about how soon is the cash value available. All right, so let's take a look at the table for the illustration again. And I want to turn your attention to the columns that are labeled accumulation value and surrender value. And keep in mind that both of these have the exact same values in them right now. And this is not always the case. So again, the policy has to be designed properly in order for all of the cash value to actually be accessible via a policy loan or via surrender. So the accumulation value represents how much cash value is in the policy at a particular time. The surrender value represents how much the insurance company would actually give you back if you were to surrender the policy. So notice here that those two numbers are identical, and that's what it looks like in a properly designed policy. So let's take a look at the second illustration where we had 26 years of premium at $20,000 a year, and we had the policy expenses shown. What I'd like to turn your attention to is the last two rows on this table, rows 27 and 20, it's year 27 and 28, where the client is aged 66 and 67. You'll notice that at that point, there are no more premiums being put into the policy, so the annual premium amount, the third column from the left, is zero. What I'd also like you to focus on is note that the premium charge is now zero. No premium charge. If you take a look at the cost of insurance and the additional charges and divide that number by the cash value, in fact, you can divide that by the cash value from the previous year if you really want an accurate estimate. But if you divide that, you're going to get a ratio of the total expenses in the policy to the total amount of cash value. And if you do that math, you're going to find out that the policy expenses are in the neighborhood of 0.25% or less. So the idea that the rising cost of mortality is going to cause a policy to lapse is another myth that we can debunk once we see an actual illustration and we understand what's going on that piece of paper. Because that's all it is a piece of paper. But it gives you insight as to what's really going on that gives you the tools that you need to totally debunk all the myths and misconceptions about life insurance. And while I don't have the rest of this table, take my word for it, as the cash value grows over time, remember that the corridor between the death benefit and the cash value is going down. And that ratio of expense to cash value stays relatively constant. So basically 1/4 or less each year is being spent on the insurance. And it doesn't rise. I mean, if the cost of insurance were to really rise, then what happens is the same amount of money is spent on life insurance, you just purchase less of it. So the ratio or the load on the policy doesn't change. So it is a complete myth that the rising cost of mortality will cause, whether it's an IUL or a whole life, will cause that policy to lapse. The whole life has the same exact charges inside of it. It's just you don't really get to see those. So anyway, I'm going to climb back out of that rabbit hole and get back with the presentation. So at this point, just to sum up, I've pretty much or hopefully destroyed that mental picture that you had of a policy where you put premiums in for a long period of time. You've got to pay monthly, you've got to pay for life, and the cash value accumulates very, very slowly. That's just not going to work for the double play. No real estate investor would ever take their money and willingly put it into something that they couldn't access for a long period of time. The model's just not going to work out. So I want you to take that mental picture that you have of that life insurance policy and reach out and grab it, crumple it up into a little ball, and throw it back over your shoulder, because we don't want to have the wrong image of how life insurance works. I want you to understand or have a picture in your head of a life insurance policy where every dollar of premium that you put into that policy is going to turn into about 85 cents of cash value. And once you're done putting premium into that policy and we reduce the death benefit to drive the costs out, the load on that cash value is going to be about 1/4 of 1%. So you don't have to pay premiums into a policy forever. So there goes that myth. But understand that the cash value is available on day one, and roughly 85% of your premium dollars go to the cash value. So with that, if you're still skeptical and you don't want to talk to a life insurance agent because we lie and we don't tell the truth and we're just salespeople, I highly recommend going out to the Facebook and taking a look at the Double Play group. I've got a link to it in the description below. It's a group that I set up, but it's meant for all of my clients, prospective clients, people who have policies from other people. It's just basically a network of people who are interested in or doing the double play. So go there, post your questions to that group, talk to people who are actually doing this, not a life insurance agent. If you want more information, then you can go out to my website, innovative-retirement-strategies.com, and pretty much every video that I do has an associated blog post. So rather than try to find different spots in this video to go back to, you can simply print out the blog post and have most of this information available to you. But there's a ton of additional information on top of that. Further, if you want to hire me as a consultant to work with you in an unbiased, non-sales manner, there's an online store where you can purchase consulting time from me. I'm happy to help anybody out, truly unbiased, and you can work with your existing agent or however you would like. So, in any case, thank you very much for viewing. If you stick around, I'll put up a couple cards for some recommended videos, but see you in the next one. Thanks.